So you want to trade Forex but have no idea how leverage and margin works. They sound confusing, but I'm going to break it down as simple as I can so after this video you can go out and know exactly what these complicated terms mean. Welcome back to the Trading Project, where I take you through my journey of learning to day trade successfully. Do me one favor before we get into it. Hit that like and subscribe button so you can stay up to date on content of what it's like learning to trade as a complete beginner like myself. Let's dive in. Firstly, what does margin mean? Margin is defined as a security deposit you need to have in your trading account to open and maintain a trading position. It's sometimes only a fraction of the total trade size, depending on leverage, and it is there to ensure that you have enough funds to cover potential losses. Each broker requires different margin percentages when taking a trade, so it's important to know what this margin percentage is when trading. Let's use a very simple example to show you how margin works when looking at a Forex pair. So right now I'm looking at the USD JPY, and you can see here that the current account I have is a 1-to-1 leverage as shown here on the top right. So if I wanted to open up a standard one lot buy on this Forex pair, my estimated buy margin is going to be $100,000. That's because the margin is calculated in the base currency. In this case, this is the USD. So with no leverage, it's going to take a full $100,000 to open a one standard lot trade. Now, I don't know about you, but most of us don't have $100,000 sitting around to start trading. So this is where leverage comes in. Leverage is like a multiplier that allows you to control a larger position with a smaller amount of capital. With a leverage of 1 to 100, you can control a position 100 times larger than your actual account balance. This is how traders with less money like ourselves can get started trading with $1,000 or even $100 while still controlling a position large enough to make a meaningful profit. Here's an easy example to visualize this. If we have $1,000 we're using to trade, with a 1-to-1 leverage we have $1,000. With a 1 to 10 leverage we have $10,000, 1 to 30 we have $30,000, and 1 to 100 we have $100,000 of margin or buying power. So now that we know what leverage is, let's go through the exact same example, only this time we're using a leverage account. So as you can see up here on the top right, I've got a leverage of 1 to 30 and I'm looking at the same USD JPY pair. If I wanted to buy one standard lot, my estimated buy margin is now $3,333. So that's different to the $100,000 that we saw before. And if you do some quick math, you can see that this is literally just dividing 100,000 by 30, and that's what our buy margin is when we're using a leverage account. So let's tie these both together to make sure you understood that example. In calculating our margin using leverage, margin is simply trade size divided by leverage. In our example, one standard lot of USD JPY was $100,000, and with a leverage of 1 to 30, this resulted in a buy margin of $3,333. This effectively means that with $3,333, you're taking a trade that's worth $100,000, and in both cases, each pip or move in that Forex pair would generate the same P&L, except with a 1-to-1 margin, you had to put up $100,000, and with the 1 to 30 margin, you only had to put up $3,333. If we had a higher leverage, say 1 to 100, we would only have to put up $1,000 to take the same trade, and you get the idea. Now, it's important to note that with leverage, although you get a larger buying power, your account value is still the original amount you put in, and your broker will not let you lose more than that amount. There will be things such as maintenance margins or stop out percentages, which is different for each broker, and these tell you that if the equity or value in your account, which is the money you initially put in, goes below a certain level, you will get a margin call or they will cancel and stop out your positions to ensure you don't lose more money than you put in. In the case of the broker I'm using, this is 50%, meaning that if my account value goes below 50% of the margin that I am using, they will stop out my trades. So to briefly sum everything up, margin and leverage are used to give you more buying power on the money you put in. When trading with margin, your account value must stay above the margin level to avoid margin calls or getting stopped out. Leverage provides traders with less capital, access to trade larger positions and grow accounts, but can also lead to quicker losses and increased risk. I tried keeping this video short and concise as I've seen countless long videos on this topic, so if this was helpful, please help me out with a like, subscribe, and I will see you all in the next one.